Okay, one thing I noted, I looked at a couple folks, so make sure when you do your payroll, and I know it asks for, it says number of owners or employees up here. And actually, when we were looking at Linwood's, I kind of noticed this, and then somebody else submitted one. Do not put any number in here for the owners, okay? And the reason for that, it seems like it wouldn't make any difference, but if you do put a 1 in there, it will make a difference down here on your unemployment, the way they've set up those formulas, and it does also for years 2 and 3. Okay, so you got to be careful and just make sure that that doesn't have anything in there, right? Because none of us are C corporations, and so we're not going to be paying unemployment for ourselves, right? Okay, you would if you were a C corporation and you were an employee of that corporation, you would pay unemployment insurance for yourself. But if you're a sole proprietor, LLC, LLP, LPGP, one of those, you don't. Okay? So check that, please. Years 2 and 3, okay, I don't know if you guys made any changes there, but you could. Again, these are some, I think I told you, these are some pretty aggressive growth rates for wages. You know, and they probably do that on purpose because, one, you're probably going to give people an increase in pay, and two, you know, if everything goes well, right, you're going to hire some new employees, some additional employees. That's probably why they have those numbers in there, but for some of your businesses, that may be a little more aggressive than what you would anticipate. And some of you just aren't designed. You know, if you got a really small business, you know, it's not designed that it's going to grow 20 or 30% in the first year or two, right? Okay, so kind of pay attention to that. Sales forecasts, I haven't really looked at any of those yet because they haven't been in there. Remember on the additional inputs, this is just a reminder, please take out the effective interest rates. Effective tax rates. Take those out, zero those out, delete them, whichever you want to do, and change this amortization period to 1. Okay. So then we get to operating expenses. You can see there's a lot of orange on here, right? Okay. And a lot of, none of this cell fills in, so you guys got to fill it in, right? But it's pretty well set up for you. I mean, they have done a pretty good job of going down the various expenses that you might have, okay, for your particular business, okay? And so you'll fill this in, right, just by what they have. Some of you may have unique businesses that wouldn't be on there. You'll note, I think, that we probably don't have inventory on here, right? Okay, and I don't think there is. Because if you set it up correctly in your cost of goods sold, that's going to show up in that sales forecast, that part of it. Okay, and so that would not be on here. Advertising, you're probably all going to have some form of advertising. Car and truck expenses, maybe not, depends on your business, right? Commissions and fees, maybe not, right? I don't know, some of you may have some. Contract labor, that's becoming a big deal for a lot of businesses. Whether you guys would have some contract labor or not, I'm not sure. Okay, again, each one of your businesses might be a little different. An example, though, might be if you're running a retail store, you might have somebody that comes in every night and does the cleaning, right? If you got a bar, you probably have a swamper, and that swamper might be a client. They could be an employee, that's fine, or they could be a contract, right? Could be a cleaning service. XYZ cleaning service is just going to come in every morning, spend a couple hours, right? You know, at the bank we had a cleaning service that did the bank cleaning, okay? Did the snow removal, did those types of things. So you might have those types of things as contract services. That's what it'd be. Legal and professional services, you know, is that going to be a monthly thing? Probably not. Probably not for most of you. If you had a reasonable payroll, you might, you know, contract that out and have, you know, XYZ accounting firm do your payroll every month. But for most of us, we're probably not going to do that. We'll probably just have them help set us up so that we can do it on our own. And then once a year or so, okay, or quarterly, we might have to do some stuff. Why quarterly? Because in a small business, you're generally required to make quarterly estimates of your tax payments. Okay, they don't let you wait until the next April to actually pay your full last year's taxes. They require that you make some quarterly payments. Okay, it's kind of a pain in the butt. small businesses or income, a lot of passive income instead of earned income. So this one, again, kind of depending on your business, are you going to have a quarterly expense if you're a small business? Yeah, might be a small quarterly expense. Okay. And that, what those, remember, you're not paying personal income taxes, so what those are the taxes that you have to pay on behalf of your employees. So I guess I should kind of clarify that. Okay. Again, you might pay those on your own. It's not that difficult to calculate those things. Okay, so you might just be able to figure out how to pay those on your own. The taxes themselves are already figured. This would only be what you would pay somebody to help you do that service. Hope I made sense there. License is kind of the same thing. That's going to be a once a year thing probably. Okay, you're all going to have probably a registration thing that you got to do with the state. I know I got to do that for a couple different things. Even for a nonprofit, once a year I got to go in and register it with the state, pay them $15. Oh joy. Okay, so you might have something like that you'd have to do. Office expense. Okay, again, this could vary widely for a lot of you guys. For some of you, it's probably not a lot, but it's probably going to be a little bit for everybody. You're going to have some paper. You're going to have to. You guys go out and buy the what's it called? The ink stuff that you got to get for your damn. Even the cheap printers you got at home it costs about as much as the dang printer, for crying out loud. You go get one of them stupid ink cartridges. They're like $50, and the printer you paid $69.99 for it when you bought it new. It's kind of goofy, but oh well. That's how they make money. So you're probably all going to have some of that. Rent or lease, maybe not. Okay, there again, maybe for some businesses. Rent or lease other business property, maybe. If you had lease and leasehold improvements, that's where this is going to be, and this is going to be the monthly expense. Not for the improvements, but for the lease itself. This is going to be your monthly expense. Repairs and maintenance, probably all going to have some of that, right? I would think. Supplies. Again, this is not your inventory, so don't confuse supplies with your inventory. Depending on the type of business that you have, supplies might be pretty minor. I mean, supplies can be the hand towels that you got to have in the bathroom, and the soap that you put in the bathroom, and the other things that you have to put in the bathroom, right? And it might be window washing stuff, those types of things that we all are probably going to have small parts of. Some of you might be in a business, maybe if you're in a cooking business or a food business where you got to buy the food gloves, right, where people they got to wear the food gloves. So that's going to be $20 a month for those darn things or something, right? Utilities, probably all going to have some utility expense unless your lease included that. Okay, that's for your heat, your electricity. Heat and electricity are going to come out of that, right? Generally, this could also include then in your utilities, we're probably starting to consider more and more our utilities to be things like Wi-Fi, those types of things that we would get. Okay, it might be our phone service, it might be other things like that. So try to make that all inclusive, and then miscellaneous is everything that we haven't thought of, right? But this does a pretty thorough job. And some of you might have some different businesses. Other stuff should have already self-filled in right down here, right? Okay, if you had a mortgage and you had some of those things like that, this is just going to be your interest. Okay, so you probably already have some things down here. Most of you probably do, right? Operating expenses here again for subsequent years. They've put in some default amounts. You may, please take a few minutes at least and go down those and see what you think. Think about what your growth rate might be, what you're anticipating for a growth rate, and how these might change. Okay. You may want to advertise more than that. Okay. So in these cases, we should be able to just change those percentages, and that'll make the changes for us. Cash flow. A couple things that we might have to put in on the cash flow as we see. Additional inventory. So we might, if we've got a seasonal business, for example, we might build up inventory at different times of the year, and we might put some of that in there, although it could be built into our sales forecast. Okay, if our sales forecast shows that, then that might already be in there. This would probably also, though, be for if you're anticipating big growth, just from year 1 to year 2 to year 3, you might want to build inventory over and above what your sales forecast says. Yeah, might be unusual, but you could. Okay, so inventory here, you can probably leave it blank unless you've got a couple of those instances that I said. Owner's distribution, we're all probably going to have some owner's distribution, right? Because you're not paying yourself anything, but you're probably going to have an owner's distribution. So figure on putting some numbers in there. Every time I send in an SBA loan, a proposal to get an SBA loan guaranteed, I shouldn't say every time, just about every time, they'd ship it back if I didn't have something in there for owner's distribution. So you can't expect the people to live on nothing. They got to have some owner's distribution. The only time we could get around that is if their spouse was literally like a doctor or a lawyer or something goofy like that and had a bunch of income otherwise. Line of credit repayments. Here I want you to pay attention. Your cash flow may be negative to start off with. And if that's the case, it may show a line of credit starting to form. I got to see where that would be. Line of credit, where is it? Operating cash balance, line of credit drawdown. Be line of credit drawdown, sorry. Okay, so it might start to form here. If you got a negative cash flow, that wouldn't be unusual. Okay, it would not be unusual for a business to have a line of credit. Our bank made tons of money on lines of credit. Okay, we did a lot of line of credits. Okay, and that was to cover some of those short-term things. But then all of a sudden, so you got drawdown here, and you get to month 6 or 7, and you're not. It's going to keep that balance, okay, unless you pay it down here. So if you're building cash, if your operating cash balance is getting big, and you're still showing a line of credit balance, I'm going to shoot something back at you and say, why don't you pay down your line of credit? You know, why would you keep paying the bank interest if you had plenty of cash to pay it down? You can always readvance on that line of credit if you need to, right? So pay it down kind of as you can. It's always good to have some cash balance, but you want to pay that down as you can if it shows that. Some of you may not. And then dividends paid. Again, we're not a subchapter C, so we're probably not going to be paying any dividends, so I wouldn't worry about that. This may fill in. I don't think it does. This is yours 1 through 3. Cash flow, got year 1. I don't know if this fills in or not. So you may have to go in and do the same thing then for 1 through 3. But it's probably not going to vary a lot. You might show an slight increase for your owner's withdrawal or owner's distribution. Yeah. Check the line of credit again, see how that's going. That's about it. Look at that. That's all white, meaning that this should all self-fill in. Okay, so on your income statement, if you've done everything else correctly, you shouldn't have to do anything on your income statement. Now, the thing you do want to do is come down here and check and see if you're making any money or not. Okay, now, do you have to make money? Well, it wouldn't be unusual in the first year for you to show a loss. That would not be unusual at all. Okay, I submitted lots of proposals that showed losses in the first year when we kind of did the budget. That's just not that unusual because you're going to anticipate hopefully some growth, right? Now, if you're still showing in year 3 down here some loss, you know, and you've had losses 1 through 3, you might want to go back and revise some stuff, right? So make sure you check down here, make sure these are positive numbers. Also, the other side of that is make sure that they're realistic. One of the biggest red flags I'd have as a banker when I look at these things is I get somebody come in and they're going to start a muffler shop and they're going to make $1 million in year 2. And I'd scratch my head and go, yeah, okay, right, sure, you know. And so I think being realistic is as important as, you know, maybe showing some profit versus a loss. So kind of be realistic in there. You can always make more than that. Nobody's going to stop you from making more if it turns out that way. But, you know, to be a little, you know, don't be too optimistic. Balance sheet. We're going to have, so you know, right up here in these prepaid expenses. In fact, you could probably fix this right now if you go to only column E and column F, so year 2 and year 3, and on this prepaid expenses, I'm pretty sure that's the one, and just delete that, okay? Not for first year, okay? So just year 2 and 3. The reason for that, and without getting into too depth, but when we changed our amortization from 3 years to 1, okay, this is still looking for a 3-year amortization, and so it's got some stuff built in here that would screw us up. Okay, that's my scientific explanation. my rocket science explanation, and we don't want to get screwed up, so if we delete that, we should be okay. I hope those are the right cells. If not, we'll figure it out. Questions? Okay, that's about as long as I want to talk today. So we can get you guys kind of going. And I think a couple of you that had submitted some stuff, I put some comments in. I wanted to come around and take a look at it, so I'll probably do that. So.